Hey, future charter holders, are you ready to unpack some more Level 2 content? Today, we're taking a deep dive into the world of bonds, but not just any bonds. We're going beyond the basics and exploring bonds with embedded options.
Yeah, these bonds are really interesting, especially if you love derivatives as much as I do.
Well, I do like a good challenge, so let's break this down. What exactly is an embedded option in a bond? I mean, I know we're talking about calls and puts and things like that, but for those of us who maybe need a refresher.
Sure, so an embedded option is essentially a right that's built right into the bond contract. This right gives either the issuer or the bondholder the option to do something special, usually before the bond matures.
Okay, so it's not just about holding the bond and collecting those coupon payments like you would with a regular bond.
Exactly. It's like having this extra layer of strategy woven right into your bond investment.
So then what are some of the most common types of embedded options?
Well, you've got the classics. You got your callable bonds where the issuer can decide to pay back the bond early.
So the issuer might choose to do that if interest rates drop, right? That way they can refinance at a lower rate.
Exactly. It's all about optimizing their financing costs. And then on the flip side, you've got putable bonds.
Those are where the investor has the right to sell the bond back to the issuer early.
Exactly. So if an investor sees rates rising or just finds better investment opportunities elsewhere, they can exercise that put option and get out.
So it's like having an escape hatch built right into your investment. I like it.
It's a great way to manage interest rate risk.
Now, what about those extendable bonds?
Oh, those are interesting. These give the investor the option to extend the bond's maturity date. So instead of the bond maturing on a set date, the investor can choose to keep it going for a bit longer.
So if you like those coupon payments and you think rates might fall in the future, it could make sense to extend the bond's life.
Exactly. You're essentially locking in that interest rate for a potentially longer period.
Right, but there's one more type that we got to talk about, and it's the one that always sounds a bit intimidating: sinking fund bonds.
Ah, yes. Those can be a bit complex, but strategically they're pretty cool. Imagine a company issues a 30-year bond. Now, instead of waiting all 30 years to repay the principal all at once, they gradually buy back portions of the bond over time.
Oh, so it's like a built-in amortization plan.
Exactly. That's the sinking fund in action. It's a way for the issuer to spread out their repayment burden and manage their debt more effectively. But here's where it gets even more interesting.
Okay, lay it on me.
Many sinking fund bonds also have call provisions. That means the issuer might have the right to call the entire bond issue after a certain period, or they might be able to accelerate the principal buybacks on certain dates.
So they've got this multi-pronged approach to managing their debt.
Right, they have options, and that's a key theme when we're talking about bonds with embedded options. These options introduce uncertainty into the cash flow stream. We don't know for sure whether or when those options will be exercised.
So how on earth do we value these things when those cash flows aren't certain? I mean, it can't be as simple as just discounting those future cash flows like we do with a regular bond, right?
You're catching on. It's definitely more complex. We have to account for that uncertainty somehow.
Well, I'm all ears. Let's hear it. How do we actually tackle the valuation of these bonds with embedded options?
The key is to recognize that the embedded option itself has value. We can actually value that option separately, almost as if it were a standalone derivative.
So we're kind of treating the bond as two separate components, the straight bond component and the option component.
Exactly. It's a way to break down the problem and account for that added layer of complexity. And depending on the type of option, that option value could either increase or decrease the bond's overall price.
Okay, so let's try to visualize this. Let's say we have a 3-year bond with a 4.25% coupon. This bond can be either called or put at par after 1 year. Now, just for argument's sake, let's imagine a world where interest rates are fixed, no volatility whatsoever.
Ah, a financial fairy tale.
Exactly. But even in this fairy tale world, those embedded options still have value.
Absolutely. So let's say it's a callable bond. The issuer has the right to buy it back at par if rates fall. That limits the potential upside for the investor, right? So that callable bond would trade at a slight discount compared to a straight bond with the same characteristics.
That makes sense. Investors are willing to pay a little less because they're taking on the risk that the bond could be called away.
Now flip it around. Imagine we have a putable bond instead. The investor has the right to sell the bond back at par if rates go up. That provides them with downside protection. So the putable bond would actually trade at a slight premium compared to the strep bond.
Okay, so even in this simplified world where rates are frozen in time, those embedded options still have an impact on the bond's price.
It absolutely do.
But of course, in the real world, interest rates never stand still. They're constantly moving up and down. So how does all of this volatility impact the value of these bonds with embedded options?
All right, let's add a dose of reality into our fairy tale. Picture an interest rate tree branching out over time.
Okay, I'm visualizing it.
At each point in time, rates can move up or down. And the wider those branches spread, the higher the volatility we're dealing with.
So more volatility basically means there's more uncertainty about where rates are going to go.
Exactly. And that uncertainty has a big impact on the value of those embedded options. Generally speaking, higher volatility is going to increase the value of those options.
Okay, so that makes sense, but I'm thinking back to our callable and putable bonds. Doesn't that mean higher volatility would actually hurt the investor in the case of a callable bond?
You're absolutely right. For a callable bond, that option benefits the issuer, not the investor. Higher volatility increases the chance the bond will be called away. It's like the issuer has more chances to refinance at a lower rate if rates happen to fall.
But for a putable bond, higher volatility would actually be a good thing for the investor, right?
You got it. For a putable bond, higher volatility increases the likelihood that the investor will get to exercise their option and protect themselves from losses.
So it's kind of like this tug of war between the issuer and the investor. Volatility plays a big role in who benefits more from those embedded options.
That's a great way to put it. And we also can't forget that the level and shape of the yield curve can also affect how those options are valued.
Okay, so it's getting complicated. We've got these interest rate trees, volatility, yield curves. It's a lot to keep track of.
It is, but trust me, it's all connected.
Well, I'm trusting you because you're the expert here. But let's get practical now. How do we actually value these bonds when interest rates are moving all over the place? Our simple fixed rate example doesn't seem like it'll cut it anymore.
You're right. It's time to get a bit more sophisticated. That's where that interest rate tree we were picturing earlier comes into play. We can actually use it to model different potential paths that interest rates could take.
Okay, so it's like we're running simulations based on different scenarios, but interest rates could go up or down at each point. How do we handle all of those possibilities?
Well, we have to make some assumptions. We're not just randomly drawing branches.
Good to know. So how do we construct this interest rate tree then?
We can use information from the current yield curve and our assumptions about interest rate volatility to build a tree that reflects the potential paths interest rates could follow over time. And once we have our tree, we can work backwards from the bond's maturity date.
Okay, I'm following so far.
At each point in the tree, we figure out whether the embedded option would be exercised given the prevailing interest rate at that node. Then we discount all the possible cash flows back to today, taking into account the likelihood of each rate movement and the potential for the option to be exercised.
So it's a lot more dynamic than valuing a straight bond where those cash flows are pretty much set in stone.
You got it.
Let's try an example. We can use our 3-year 4.25% bond, but this time let's assume a volatility of 10%.
Perfect. So we start with our tree, branching out over those 3 years with rates going up or down at each node. We're using our 10% volatility assumption along with the information from the current yield curve to calculate those potential rates.
Okay, so we're not just making up those rates. There's a method to the madness.
Exactly. Now, let's say this is a callable bond. At each point in the tree, we ask ourselves, would the issuer call the bond at this interest rate?
So if that potential rate is lower than the bond's 4.25% coupon rate, the issuer would probably want to refinance at a lower rate.
Right. They're only going to exercise that option if it makes financial sense for them.
Okay, so we figure out at each point if the bond is likely to be called, then we discount all those possible cash flows back to today, taking into account the probabilities of each path.
You got it. And that gives us the value of the callable bond. And by comparing that value to the value of an equivalent straight bond, we can isolate the value of that embedded call option.
It's like we're figuring out how much extra investors are paying for the risk of having the bond called away.
Exactly.
Now, this is all great, but we've been pretending these bonds are risk-free. And in the real world, that's almost never the case, right?
You're right. We can't forget about default risk. We've been so focused on interest rate risk, but there's also the risk that the issuer might not be able to pay us back at all.
So how do we incorporate that risk into our valuations?
Well, we have a couple of options. We can adjust our discount rates to reflect that added risk of default, bump them up a bit to be more conservative. Or we can try to build a model that explicitly incorporates default probabilities over time.
Okay, so either we tweak our discounting process or we get even more sophisticated and try to model those default probabilities directly.
Exactly. And there's a handy tool that often comes up when we're dealing with bonds that have embedded options and credit risk. It's called option adjusted spread, or OAS for short.
Okay, I've heard of OAS. It's kind of like the Z spread, right?
Yes. Remember the Z spread? That spread we add to the risk-free rate to value a bond.
Yeah, it helps us account for credit risk.
Well, OAS is similar, but it takes that embedded option into account.
So it's a way to compare bonds that have different embedded options, even if they have different levels of credit risk.
Exactly. It helps level the playing field so we can make more apples-to-apples comparisons.
That makes a lot of sense. Now, it's hitting me that knowing how to value a bond is only part of the story. We also need to know how its price might react to changes in interest rates. We need to understand its duration, right?
You're absolutely right. Duration is key, and when you throw embedded options into the mix, things get a bit more complex.
Yeah, I was about to say, I thought modified duration was all about measuring how sensitive a bond's price is to interest rate changes.
It is. For straight bonds, modified duration is a great job. But for bonds with embedded options, those expected cash flows change as interest rates change.
Ah, so our trusty modified duration calculations might not be so reliable anymore.
Right, those embedded options can really throw a wrench into things. But thankfully, we have another tool at our disposal, effective duration.
Effective duration.
Yep. Also sometimes called option-adjusted duration. It's a measure of duration that takes into account how that embedded option itself changes in value when interest rates move. That gives us a more accurate picture of the bond's overall price sensitivity.
Okay, so we're essentially acknowledging that those cash flows aren't set in stone. They can move around depending on whether the option is exercised.
Exactly.
So how do we actually calculate this effective duration? It sounds a bit complicated.
It can be. We basically shift the entire yield curve up and down by a small amount, and then we revalue the bond at each point.
Oh, wow. So we're playing with the whole yield curve now.
We are, and then we use a formula to calculate the percentage change in the bond's price for that given change in yield.
Phew, that's some serious number crunching.
It is, but the good news is most financial software can handle these calculations for us.
Thank goodness for that. But before we move on from duration, you mentioned something about one-sided durations, up duration, and down duration. What are those all about?
Ah, yes, that's an important nuance. You see, bonds with embedded options don't always react symmetrically to rate changes. They might react differently to an increase in rates than to a decrease in rates of the same size.
So it's not always a perfectly predictable up or down movement.
Exactly, and one-sided durations help capture that asymmetry. Up duration tells us how much the bond's price is likely to fall if rates go up. Down duration tells us how much it might rise if rates fall.
So it's a more complete way to look at those potential price swings, especially when those embedded options are getting close to being in the money.
You got it. It's all about understanding both the magnitude and the direction of those price changes.
All right, let's shift gears for a moment and talk about a special type of bond that we often encounter in the world of structured finance, capped and floored floaters.
Capped floaters and floored floaters, yes, they're quite interesting.
They sound like a mouthful. What exactly are we talking about here?
So these bonds have a coupon rate that's linked to a benchmark rate like LIBOR or SOFR. You know, those rates that move up and down with market conditions?
So it's like a floating rate bond.
It is, but there's a twist. There's either a maximum limit or a minimum limit on those coupon payments.
Ah, so that's where the capped and floored come in.
You got it. The cap sets a ceiling on the coupon rate. The floor sets a bottom. It's all about managing that interest rate risk.
So how do we value these capped and floored floaters? I'm guessing our trusty interest rate tree is going to make another appearance?
It is. We can use the same general approach, but we have to adjust the cash flows at each point on the tree if the cap or floor is triggered.
So if the reference rate plus any spread goes above the cap, we adjust the coupon payment down to the cap level. And if it falls below the floor, we adjust it up to the floor level.
Precisely. We're building those cap and floor constraints directly into our valuation model.
I see. So it's like we're constantly checking whether we need to make adjustments as we move through that interest rate tree.
Exactly.
Okay, so we've got these capped and floored floaters. We've got our callable and putable bonds. We've got sinking funds. Are we missing anything?
We can't forget about the rock stars of the embedded options world, convertible bonds.
Convertible bonds. All right, let's talk about those. They always seem a bit mysterious to me. Like, are they a bond or a stock?
That's the exciting part. They're kind of both. They give investors the steady income of a bond, but with the potential for some stock-like upside.
So it's like a hybrid security.
Exactly, and that dual nature makes them fascinating and challenging to analyze. But before we dive too deep, let's make sure we're all on the same page with some key terms.
Okay, sounds good. What terms do we need to go?
So we've got the conversion price. That's the share price at which a bondholder can convert their bond into shares of stock. Think of it as the magic number that unlocks the equity potential of the bond.
Okay, conversion price, got it.
And then we have the conversion ratio.
The conversion ratio.
Yep, the conversion ratio tells us how many shares the bondholder gets for each bond they convert. It's like the exchange rate between debt and equity.
I see. So if the conversion ratio is 10 and I hold one bond, I can convert it into 10 shares of stock.
Exactly.
Now things can get even more interesting because sometimes that conversion price might need to be adjusted if the company does certain things like stock splits or dividends, right?
You're absolutely right. It's all about making sure the bondholder's potential equity stake isn't diluted by those corporate actions. Those adjustments protect the bondholder's rights as the company changes and grows.
Okay, that makes sense. So how do we go about valuing these convertible bonds when they have this dual nature? Can we just use our traditional bond valuation methods?
Not quite. It's more complex than that. We have to consider both the bond's value as a straight bond and the value it could have if converted into stock.
Okay, so there are two sides to this valuation coin.
Exactly. We call the bond's value as a straight bond its straight value. That's like a floor for the convertible bond's price. No matter how poorly the stock does, the bond should, in theory, never trade below that straight value. And we can estimate the straight value using our familiar discounted cash flow techniques.
Okay, so that anchors the bond to its fixed income roots. Now, what about the potential equity value?
Right, that's what we call the conversion value. It's simply the current stock price multiplied by the conversion ratio. It tells us what those shares would be worth right now if the bond were converted.
Okay, so we've got the straight value as our floor, and then we've got the conversion value reflecting that equity potential. But here's what I don't get. Why would a convertible bond ever trade at a price that's higher than both its straight value and its conversion value?
That's a great question, and that's where things get really interesting. That difference, that premium, is essentially the market's way of valuing that embedded call option on the stock. Investors are willing to pay a little extra for the potential to participate in the upside if the stock price goes up.
So it's like they're paying a premium for flexibility.
Exactly, and to understand that premium, we often look at the market conversion price and the market conversion premium.
So the market conversion price is basically the price investors are effectively paying for the stock by buying the convertible bond.
Right, you can think of it as a break-even point for that conversion feature.
And then the market conversion premium tells us how much extra investors are paying for that potential upside.
Exactly.
It's like we're getting a glimpse into what the market is thinking about the company's future prospects. If that premium is high, investors must be feeling pretty optimistic.
That's a good way to think about it.
So we've talked about valuation. Now let's dive into the risk and return characteristics of these convertible bonds. I mean, how do they compare to just owning the stock or just owning a regular bond?
All right, so imagine the stock price is way below the conversion price.
Okay, I'm picturing it.
In that scenario, the convertible bond is going to behave a lot like a straight bond. Remember those busted convertibles we talked about?
Yeah, those are the ones where the conversion option is so far out of the money that it's basically irrelevant, right?
Exactly. So things like interest rate movements and credit spreads are going to be the main drivers of the bond's price in this case. But as the stock price starts to rise and get closer to that conversion price, things start to change. The bond starts to become more sensitive to those stock price movements and less sensitive to those interest rate fluctuations.
So it's like this gradual transformation from a bond-like instrument to something that behaves more like an equity.
You got it. And once that stock price actually crosses over that conversion price, the convertible bond essentially starts acting like the underlying stock. Its price will move in sync with the stock price.
So it's this amazing dynamic where the bond's personality shifts as the stock price changes.
I know, it's pretty fascinating, right?
Now, what about forced conversion? Can you remind me what that's all about?
Sure. So with forced conversion, the issuer basically says time's up. They start to call the bonds, essentially forcing the bondholders to convert their holdings into stock.
So it's like the issuer taking advantage of those favorable stock market conditions and cashing in on that conversion option.
Exactly. They usually do this when the stock price is significantly above the conversion price. It makes sense for them because they can swap out their debt for equity at a great time.
But for the bondholder, it might not always be a happy occasion, right?
It depends. They get those nice stock gains, but they also lose the steady income they were getting from the bond. They might even have to pay capital gains taxes on those stock profits.
Okay, so it's a mixed bag.
It is, and there's also this concept of a protection period for convertible bonds.
It's a protection period.
Yeah. Even if a bond is callable, there's typically a period of time where the issuer can't force that conversion.
Why is that? Wouldn't the issuer want to force conversion as soon as possible if the stock is doing well?
You'd think so, but that protection period is there to give bondholders some peace of mind. It's like a promise that they'll receive a certain number of those interest payments before they have to worry about being forced into that equity position.
So it's about balancing the needs of the issuer and the bondholder.
Exactly. It makes those convertible bonds more appealing to investors.
Okay, so after that protection period is over, the issuer can call the bond, usually at a premium to the bond's face value. So that's like a little bonus for the bondholders to make that forced conversion a little more palatable.
Right. And the call premium usually shrinks over time. That creates an incentive for those bondholders to convert sooner rather than later.
So it's like a game of strategy between the issuer and the bondholder, each trying to get the best outcome for themselves.
You got it. That's what makes convertible bonds so interesting. There's this constant interplay between the world of debt and the world of equity, and the rules of the game can change dramatically based on how the markets are moving.
Wow. I've started to see why convertible bonds are such a popular topic for the Level 2 exam. They really test your understanding of both the bond market and the stock market.
They do, and they highlight the importance of understanding those embedded options and how they can affect a bond's behavior.
Well, I think we've covered a ton of ground today. We've talked about callable bonds, putable bonds, those fascinating convertible bonds, and even touched on some advanced concepts like OAS and effective duration.
It's been quite a journey.
It has, but I have a feeling we're not done yet. There's still more to explore when it comes to these embedded options.
You know, when we talk about convertible bonds, it really is like they can change their behavior depending on what the stock is doing.
Yeah, that's a good point. It's not a static relationship. So we talked about all those key metrics for convertible bonds, like conversion value and straight value and market conversion price and all that. Can you just walk me through how they all work together again?
Sure. So remember, the conversion value is what the bond would be worth if we just converted it to stock right now. It's all about that instant equity potential. And then you've got the straight value. That's like our safety net. It's what the bond would be worth if we just ignored that conversion option and treated it as a plain vanilla bond.
Right, so no matter how badly that stock does, the convertible bonds should at least theoretically be worth that straight value.
Exactly. Investors always have that option of holding it to maturity and getting their principal back. That downside protection is one of the things that makes convertibles attractive to some investors. Now, the market conversion price and market conversion premium, those help us understand how the market is viewing that embedded call option, that option to convert the bond to stock.
Okay, so the market conversion price is telling us what investors are basically paying for the stock by buying the convertible bond. It's that break-even point for the conversion feature.
Exactly. And then the difference between that market conversion price and the actual stock price, that's the market conversion premium. That's the extra that investors are willing to pay for that chance to participate in the upside.
Okay, so a high market conversion premium would mean that investors are pretty bullish on the stock.
Right. They're willing to pay a premium for that right to convert the bond.
So we can look at those metrics to get a sense of market sentiment.
We can. It gives us valuable insights.
Now, can we talk a little bit more about the risk and return characteristics of convertible bonds? I mean, how risky are they compared to just holding the stock outright or compared to just holding a straight bond?
Sure. So let's start with a scenario where the stock price is way below the conversion price. Remember those busted convertibles?
Yeah, those are the ones where the conversion option doesn't really matter.
Right. It's so far out of the money that it doesn't have much impact. In that case, the convertible bond acts a lot like a regular bond. Interest rate movements and credit spreads, those are the main things affecting the bond's price.
Okay, so it's basically all about that fixed income component.
Exactly. But then as that stock price starts to climb and get closer to the conversion price, things start to shift. The convertible bond starts to pay more attention to what the stock is doing and less attention to what's happening with interest rates.
So it's gradually becoming more like an equity investment.
Right. And once the stock price actually goes above that conversion price, the convertible bond basically becomes the stock.
Oh, wow, so it really does transform.
It does. It's pretty cool to see how that dynamic plays out.
Now, what about forced conversion? We talked about that a little bit earlier. Can you just remind me how that works again?
Of course. So with forced conversion, the issuer decides they're going to call the bond. They're essentially telling those bondholders, hey, it's time to convert your bonds to stock.
So they're taking advantage of a good time in the stock market.
Exactly. The stock price is usually well above the conversion price when this happens. It makes sense for the issuer because they can swap out that debt for equity when things are looking good.
Okay, so it's a smart move for the issuer. But what about the bondholders? Are they happy about this?
It's a mixed bag. On the one hand, they're getting those stock gains, which is great, but they're also losing those steady interest payments from the bond. They might even have to pay taxes on those stock profits.
Oh, right. So it's not always a clear win for the bondholder.
Right. And remember, we talked about those protection periods for convertible bonds.
Oh, yeah. That's where the issuer can't force conversion even if they wanted to for a certain amount of time.
Right. Even if the bond is callable, there's usually a period of time where the issuer can't force that conversion. It gives the bondholders some reassurance. They know they're going to get at least a few of those coupon payments before they have to worry about being forced into the stock.
Okay, so it's a way to make those convertible bonds a little bit more appealing to investors.
It is. Now, once that protection period is over, the issuer can call the bond. They usually do this by offering a little premium above the bond's face value.
Okay, so that's a little thank you to the bondholders for giving up their bonds.
Exactly. And that premium usually gets smaller over time. So there's this incentive for bondholders to convert sooner rather than later.
Wow. It's like a game of chess.
It is. There's this back and forth between the issuer and the bondholder. They're both trying to make the best moves based on what's happening in the market.
Convertible bonds are a lot more interesting than I thought.
They really are, and they're a great example of how those embedded options can make things exciting in the world of fixed income. I think we've spent a good amount of time on convertibles now. Maybe we should shift back to our broader discussion of embedded options and their impact on valuation.
Yeah, sounds good. Let's see what other insights we can uncover. Okay, so we've talked about how to value these bonds with all their embedded options, and we've gone through the different types, like callable and putable bonds and those interesting convertible bonds. But I'm thinking now, how do people actually trade on these features?
That's a great question. You know, we've been really focused on understanding how they work and how to value them, but there's a whole other side to this.
Yeah, like how do investors actually use these embedded options to try and make money? What are the strategies involved?
It's all about spotting those opportunities and figuring out how these options are going to behave in different market environments. Like, let's say you're looking at a convertible bond and you think it's mispriced. Maybe the market isn't fully appreciating that embedded call option, or maybe they're not factoring in the possibility of forced conversion.
So you're saying there could be chances to buy those undervalued convertible bonds and then potentially profit as the market catches on.
Right. You could also look at strategies where you combine bonds with different embedded options, like maybe you buy a callable bond and at the same time you sell a put option on that same bond. That could be a way to hedge against certain interest rate changes.
So it's about thinking strategically and not just looking at these bonds in isolation.
Exactly. You're building a portfolio and using those embedded options to try to manage risk and maybe boost your returns. And as you keep learning more about fixed income, you'll delve even deeper into these strategies.
It's pretty cool to see how all of these pieces fit together. It's not just about memorizing formulas. It's about really understanding how the markets work.
I agree. The CFA program really emphasizes that critical thinking and being able to connect the dots between different concepts.
Well, I think our brains are officially full of embedded options knowledge for today. It's been quite a deep dive.
It has, but hopefully our listeners are walking away with a better grasp of these instruments and all the opportunities and challenges they present.
Absolutely. So to all our future charter holders out there, thanks for joining us on this journey into the world of bonds with embedded options. Keep studying, keep practicing, and never stop learning.
And don't forget to stay curious. The world of finance is constantly changing, so keep asking those questions and keep exploring those new ideas.
Until next time, happy studying.